And really, it's a good thing, right? Because if you don't know about those problems and they pop up, then you're the one at fault. By us learning that stuff, it's made us just be more knowledgeable on some of those things, which at the core is what we're focused on, right? We're buying a piece of property and you need to know what those problems can be. So it's been really great.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show and getting some great value for your investing needs, you already know what I'm asking you to do. Make sure you leave us that rating and review. We want some honest feedback. It helps us make the show work harder for you, but it also helps other listeners find this show and get the value they need to grow their real estate portfolio. Listen, if this is your first time listening to the show, or for some reason you just haven't done it yet, be sure to hit that follow or subscribe button so you don't miss an episode. Now, we've got a great show today. We're going to be talking to Chris Grenzig. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Now, Chris Grenzig used to work for Toro Real Estate Partners from 2016 to 2020, where they acquired over 4,000 multifamily units across 23 properties. Then he moved on to acquire his own properties and started JAG Capital Partners, a vertically integrated multifamily company that would buy multifamily asset management, property management, and construction management focused on the 10 to 80 unit value add property range. Let's welcome to the show, Chris Grenzig.
Yeah, thanks for having me.
Absolutely. Hey, Chris, I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. So, like you said, I used to work for Toro. That was kind of one of my early starts. I did a little bit before that, but it was mostly the real estate stuff that I got introduced to. And John and Don were great. I got to work directly underneath them. The first year, I just did like asset management for everything, and then the last 3 years, I kind of ran and grew the portfolio in Florida. So we grew that to 1,000 units. I kind of oversaw everything. I got my hands in a lot of different features, which was great. And then in 2020, I was buying a 16-unit property in Jacksonville for myself and a family member. And during that process, I decided I was going to, leave Toro on great terms and, start my own thing, and decided I was going to move from New York to Florida and just start doing property management and construction management, which I'd never done before, and just kind of do my own thing. So moved down, started doing that. And we spent about $35 a door on every single unit there, kind of renovating that, refinanced it, pulled out some money, and we still own that today. And then from there, we bought a few more properties, some JVs, some, kind of smaller syndications. Our largest property was $3 million or something like that. So nothing too crazy, but kind of focused on that smaller scattered site space where a lot of out-of-state people aren't focused, no office, no on-site staff. And we've bought 150 units and we still own 51 today. So we've sold a few. And then we haven't really bought anything since 2022. It's been really tough to make value add multifamily work in the Florida region. I think we're kind of coming towards the tail end of that. I think, maybe in the next year or two, we'll start being more active. But since then, we've actually opened up our management side of the company to other owners. So we got licensed and insured and all that stuff. So now we do both. So we still, are actively looking for investments and, trying to find things that work. And then we also, manage for other owners as well. And that's kind of where we're at today. We're still looking in that 10 to 80 unit space. We look in the Jacksonville and Orlando, Florida markets.
Yeah, Chris, I love hearing your background, man. You talked about, working for Toro, having a chance to work with that group, helping them grow and scale, helping acquire over 1,000 units during your time there, and deciding in 2020 to make a big shift, moving down to Florida, deciding to kind of buy a 16 unit, You wanted to run it yourself, the property management side of it, the construction management side of it. And from there, really focus on more JV, smaller type deals where you could kind of partner, raise a little bit of capital where needed, but really run the property and projects yourselves. So you're not really competing with some of the bigger investors and bigger operators. And that's kind of your focus today. Now you also work with third party management, meaning that you help other owners and take on property management for them as well. I want to go back to that moment in 2020 because obviously that was a pivotal year for most people, right? To take a moment to reflect and figure out what's going on in their life, what changes they want to make. You were sounds like you were in a great groove at Toro, but moving from New York down to Florida to be a property manager on a 16 unit feels like a bit of a, a stark adjustment from where you were. Just walk us through like kind of your decision process and more specifically what were you trying to solve? Did you feel like you just needed more ownership? You wanted to be closer to your assets? Why did you decide to move to Florida and then take on the property management side, especially since that wasn't what you were doing previously?
There were a lot of factors, and some of that was wrapped into being in New York and being, basically locked down during this COVID period and feeling a little bit shut in. But largely, it felt like a good time to make that shift where at Toro we had, put acquiring new properties on hold as we were trying to navigate COVID and what was going on. Um, at that time, early in 2020, I thought maybe it was going to be this ridiculous buying opportunity of like a 2008 type crisis, and that didn't kind of materialize. But because I had less work to do at Toro, I kept looking for properties, and I was doing what I normally did anyway. I was just talking to a couple extra people. So it didn't really take away from anything I was doing at work. And this property came up that was around the corner from a deal we had just bought with Toro. It was the same year built, the same floor plans, the same submarket, the same rents, the same construction. And I was getting it for about 15 a door cheaper. And I was just kind of like, this seems kind of too good to be true type of thing. And when we were buying it, I didn't have any intentions of leaving, but a lot of people just asked if that's what that meant. And I said no, but I started kind of giving it a thought of maybe this is something I should do and what should it entail. And we were having some frustrations in Toro at the time with a disconnect between our contractors, our property managers, and us, of not being fully in tune of what was going on with a lot of the renovations we were doing. It was manageable. We were getting through it, but it wasn't what I felt it should be. And I think part of that was the amount of projects that were being done probably necessitated a specific project manager, knowing what I know now, where that should have been either someone we hired, someone in the property management, somebody should have been sitting there, not as an on-site manager, not as a regional, not as a, there should have been a dedicated person just kind of sitting in the middle and taking care of all of that and staying on top of it. And my idea was moving down and doing this was, I didn't really know if it was a good idea or a bad idea, but I knew my worst case scenario was I was going to come down and learn a heck of a lot, and I could always go find another job if it didn't work out. And it ended up being one of the best decisions I ever made. Besides having the company, I also ended up meeting my now wife, and we have a house, and it's been great. But the amount of knowledge I've gained by being closer to the process, being more involved in the management and day-to-day operations, learning the construction side. I mean, just understanding how plumbing works, how electrical works, how AC works, all these little nuances that come into it and how these problems are, has made me significantly better at evaluating new properties and what these potential problems are and where skeletons might be hiding. In some ways, it's actually been a hindrance for us in some properties that we might have otherwise bought. But because the stuff I know and the problems I know that can arise, it actually holds me back or makes us offer a lower price or want to raise more money. And really, it's a good thing, right? Because if you don't know about those problems and they pop up, then you're you're the one at fault. But by us learning that stuff, it's made us just be more knowledgeable on some of those things, which at the core is what we're focused on, right? We're buying a piece of property and you need to know what those problems can be. So it's been really great.
Yeah, Chris, I love what you just talked about, right? So one, what I'm hearing you talk about is one, at that time in life, you didn't have some of the responsibilities that other people may have, right? You were able to just decide, hey, you know what? I'm single. I think there's a great opportunity. We just bought an asset in Florida, exact same submarket, same layout, same vintage. I know this property because I just looked at it for this company. So if I can buy a smaller property, man, the comp's built in. I've already done all the research. This is a great
Mhm.
opportunity. So you go down and take advantage of that. But you also talked about, taking advantage of the opportunities you were given. And if, for our younger investors listening to this, there's a lot of value because there will always be opportunities. You just have to be willing to walk through that door, right?
Mhm.
And for you, again, starting with your work at Toro, but then when you came across the 16 unit, deciding to move, take that leap of faith, recognizing that the worst case scenario is you essentially go back to the same position you were, right? You go get a job, you work for someone else, and you now have more knowledge of how to be better in your job. The best case is obviously building out a portfolio and building out a company that allows you to have more control and financial flexibility over your future. So, a great opportunity for you to take that. You mentioned a couple other things. One, when you looked at the work and the knowledge that you were able to gain, it allowed you to become a better investor. And the flip side of that is with that experience and knowledge, deals that you probably would have purchased before, when you look at them, you recognize, hey, there could be some potential challenges here. And that comes with experience. And that's one thing that younger investors or newer investors have to understand. This is not just about spreadsheets and Excel documents. You have to understand where potential risks are. And that either comes from your own experience as an investor, working with a mentor or partners who have that experience, work with contractors or someone else who can walk these properties with you. But there are issues that come up, especially market dependent issues that arise, and that's going to allow you to be a sharper investor. Now we look at the infrastructure a lot more closely. Well, why? Well, we bought a 28 unit building in an older area, and I spent way more money than I anticipated replacing plumbing stacks. And when you're replacing plumbing stack after plumbing stack, you say, good Lord, like, I'm sitting here going crazy, like, wait a minute. Another one broke. I felt like every month I was getting a report that we had to replace the plumbing stack, right? Or I'm getting these
Mhm.
phone calls that there was an issue with the plumbing. So we adjust our buying criteria now. We either plan for that up front to say, hey, we need to update all the plumbing, or more accurately, what I really look for is I want to see that all the plumbing has already been updated to PVC pipes, right? So that's not something I want to take on because it's just a massive headache. It's a money sucker, and it just really makes it difficult to implement your business plan. So as you gain experience as an investor, your criteria changes, the things that you can take on, the problems that you can solve, you get really clear on that. And that's going to allow you to be more effective and efficient with your investing career. Let's talk more about that because you talked about now you've expanded the portfolio, you bought over 150 units, you now work with other investors to help manage their portfolio. What are some of the challenges you see that you've either overcome in your own portfolio or in working with these third party owners that they see and you're helping them overcome those challenges?
So I think the one biggest challenge right now in Florida, especially, and Jacksonville mainly, is we are having NOI compression across the board. There's been a huge amount of building in the last 2, 3 years. So, and I mean, so much so that, the old adage was buy in some markets where it's supply constrained, right? Where you can't really build. So we've bought in two areas in Jacksonville where one is a historical area where it's basically impossible to build brand new. Another one is an area called Orange Park where the required density there is so low, it's really next to impossible to tear down anything old to build new. And most of the land there is already built up. There's very few pieces of vacant land there. It has not mattered one bit. The whole market has just been hit. A, B, C, D. I mean, rents have been dropping. Like not even just staying flat, they've been dropping. And some areas are worse than others. Some property types are worse than others. So when we were getting 1350 for 2 bedrooms, they now go for 1250. When we were getting I mean, we were getting studios at 1,100 and now we're renting them at 900 or 950. So, I mean, you're talking about huge movements in income that have hugely affected our business plan and other owners as well, right? On top of that, insurance has doubled in the past couple of years and tripled in the past several years. When I first started buying properties in Jacksonville with Toro back in 2017, our insurance was $350 a unit. Now it's roughly anywhere from $1,800 to $2,200 a unit.
Wow.
So you might be able to get a little bit lower depending upon some stuff. But that's kind of like the guidance I'm getting for new acquisitions is in that range. And that's for, C and B class, 60s to 80s built, wood frame stuff. If you get some concrete, maybe you get 1,600, right? So again, I'm talking in overall generalities. Don't, if you get a quote for 1,500, don't be like, he was wrong, right? Every property's so different, so specific, but that's kind of the range that I'm normally getting. So you're having this problem with insurance. Obviously, everybody had the problem with interest rates going up, but that's still impacting too. And then you have the general increases in materials and labor and stuff too. That's affecting everything. So HVACs used to be 2,000 to 2,500 to replace. Now they're $4,000 to $5,000. So you just had this from the top down pressure downwards, and from the bottom up, you've had pressure upwards. So your margins are just getting squeezed. Your NOI is getting squeezed. And it's tough being an owner right now when, and leasing's taking way longer. You used to rent something up in a week and now it takes, 20 to 45 days, again, depending upon the property type, submarket, whatever. You're having to offer concessions now when you never used to have to offer concessions. So it's this environment where if you invested in Jacksonville from 2010 to 2022, this is an entirely different world to you. You just to sit back, do nothing, rents would go up, stuff was cheap, you'd make money, you could refinance. You could basically throw a dartboard, and even if you overpaid for something, you probably still made money. Now it's wildly different. So it's just been really challenging both as an owner and as a manager for other people to say like, hey, like this is what it is. I can't change any of this stuff. And now the nice thing is I can go to these owners and be like, guys, I'm in the same boat as you, right? Like this is the stuff we've been battling for the past 2-3 years. And this is just the stuff you have to plan for. But because of our background, we're able to have some of those conversations of like, hey, well, look, you're already spending this. Why don't we do these 2-3 things, spend a couple extra $1,000 and get an extra $150 in rent? And yeah, it's not this amazing ROI on the money you're spending, but at least it's helping a little bit. It's help offset some of that stuff. Or we also take a look and say like, look, like, it'll kind of circle back to this conversation of buying new properties, but there's a property for sale right around the corner from that first property we bought. And it's the exact same thing, same floor plan, same vintage, all this stuff. But we spent a bunch of money, like I said, $35 a door doing repipes and updating the exterior, redoing the inside, new cabinets, floors, countertops, appliances, all this stuff. We're getting $50 more in rent right now. And most of their stuff is, somewhat updated, not in bad shape, but, nothing really updated. So I look at that property. I'm like, why would we spend $20,000 a door to renovate this to get $50 more? So then you're actually starting to see the inverse now, where it's like, okay, can we just buy this and run it as a stabilized asset? And maybe in 5 years, if you go to refinance, if you pull out some proceeds, then we can take that money, reinvest it back in when there's more of a gap in potential renovations. You can reinvest that and then gain some more equity and do that. And those are also the conversations we're starting to have too, which is totally the opposite of what you've heard about multifamily for the past, 5-10 years of, it was always spend then $10,000 a door, get an extra $100 in rent, value add, right? And now it's like, hey, spend no money and you only rent it for $50 less. That's a better ROI than spending the money to try to get the $50 more.
Chris, I want to dig in. I want to dig in here a little more because I think this is fascinating. This is exactly what I want to get to, right? What you're talking about is a couple of challenges that have come up. One, there is just compression, right? The margins have gotten really slim, where on a rental income standpoint, you're not able to charge as much. There's been so much new supply that's come online that you're offering concessions. You're not, what was used to rent for $13.50 is now going to, for $12.50. So rents are actually going down as opposed to increasing in the market. On top of that, you're offering concessions because it's taking longer and longer to get these leased. But on the other side of that, your expenses have gone up. Insurance has gone up 4 or 5x over the last 7 or 8 years. Your again, contractor costs, your supply costs, all that has increased. So it's just harder to make money. And you talked about specifically on that 16 unit, you guys spend around 35,000 a door on renovations. There's another comp property, same area, same vintage, and that property was not renovated, and you're only getting a $50 premium. So what's happening and what you're getting at is you really have to step back on your business plan now to say, well, it doesn't make sense to spend $30,000, $20,000 a door renovating a property to make $50. So we have to rethink our business plan. And I think that's where we're at in the market, and obviously you're talking about Jacksonville specifically, but many markets are going through some version of this where that value add business plan that was so popular, 3, 5, 7 years ago, buy a property, invest some capital in renovations, charge $200 more in rent, refinance or sell and cash out. That ain't working today. And a lot of people are finding that out, unfortunately, when that is their business plan for an asset they currently own. So I want to come back to this where you were going. How do you pivot, particularly with those owners who maybe came into a property with that business plan, and they're looking at you to say, hey, I wanted to spend $10,000 a unit on renovations. I was projecting to get an extra $150 or $200 in rent. That's not happening. How do you pivot and adjust?
There's only so much you can do, right? You can't do too much. I think right now the main thing is focusing on renewals, occupancy, and increasing revenue, right? So where in the past you might trade off, go to 92, 94% occupancy so you can push rent $150. Now it's more important to renew somebody at flat, or maybe even give them a 25%, or excuse me, $25 discount on their current rent to keep them in place. Because if they leave, it's 2 weeks to turn it, 30 days to lease up, 2 weeks for them to move in, $1,500 on a turn. That's way more expensive than 25 times 12, whatever that is. I think that's $600, something like that. I'm 400. Math is tough. So that's the stuff you're starting to weigh up, is like, all right, what are the things we can do to try to help as much as we can. Then I'll say the nice thing, but the nice thing is this is not something that's new. This has been happening for the past 2 years. So any owner that I'm talking to now is kind of accepted what's going on. I think a lot of the conversations, if we'd been having them 18 months ago, there'd be a lot more pushback. Now there's still some owners who, want to rent it for what it rented 2-3 years ago, and it's not the same, especially on like the single family home side, because we do manage that stuff as well, not just apartments. But for the most part, it's now been long enough and people have kind of got through some of those aches and pains that everyone's kind of accepted what's going on. But I think what is good is that Jacksonville and Florida in general, and probably a lot of these areas that are similar, that have had a large amount of supply being built, is there is some good tailwinds coming through. And one of the main ones is, new construction starts have dropped substantially. So where, new construction starts is like when someone pulls a permit to start building, right? And that's different from what's currently being built, right? Because the development cycle is at least 3 years, 2 years, if not 5. Because some of that is before the first permit is pulled, right? You got to buy it, due diligence, all that stuff. But a typical development takes 5 years from, contract to completion. But that new construction start is really a 3-year lag, because by the time they start, build it, lease it up, stabilize it, and they're done, so there's no more units affecting your supply and demand in the market, there's a serious lag. New construction starts for the past 2-ish years have dropped substantially. Some reports I've seen have said it's now below like the 2015 to 2018 level, which was lower than the 2020 to 2022 level, which was basically setting records in Jacksonville and close to setting records in Orlando. Um, so in the next few years, there should be a noticeable drop in new construction being completed, which will then mean less supply in the market. And as long as the demand continues to grow as it has been because of job growth, population growth, unemployment staying low, things of that nature, it should hopefully shift back to what we were experiencing in that 2015 to 2018 period, where you're seeing organic 3 to 8% rent growth, depending upon property, submarket, all that stuff. So there is some tailwinds coming, and that's the conversations we're having with people of it's, just let's do what we can to stay alive basically and continue to operate and just understand that like, if you were looking at a 20-year picture of ups and downs in a cycle, this is a low point. And, it's really what can we do to mitigate any problems we're doing and then, try to set us up for the future and growth and all that stuff again.
Chris, I think what you're saying is really important because it's easy for investors to be reactive. I think one of the challenges in the stock market is you can look at it and see, oh, the stock price dropped 20% today, right? And people get emotional, reactive to that. One of the things with real estate is the value of your property only matters really the day you buy it, the day you sell it, or the day you refinance it. So if you can stomach and just work through these changes, you'll be fine. And what you're getting at is right now we are in a bit of a valley because so much new supply has come online. And for context, the last 2 years have seen the most amount of new supply in the last 40 years. So for like you said, from 2015 or 2016 up to 2022, it was fairly easy to push rents because there just wasn't a whole lot of new product available. But with so much new supply that has come online, particularly in the last, 24 months, now renters have many more options. And when with those options, whether it's even if you're not an A class, renter, it's one of those rising tide situations where those folks have more options. So if you're competing for that renter, everyone has a choice to pick something a little bit better because rents are going to come down. There's lots of concessions being offered, but this is a temporary thing. And what you're getting at is when you forecast the new permits that have been pulled, it is a drastic drop off. It's a literally a 180, right? We had the last 2 years the most amount of new supply to come online. I think the next couple of years may be like some of the least amount of new supply to come on in like the last 30 or 40 years. So it is really a drastic swing because those interest rates have changed most developers' perspective of what they're willing to pay and what they're willing to do. So with that being said, there should be some balance that comes back to the marketplace over the next maybe 24 to 36 months. And with all that in mind, what you're basically saying is for current investors, current owners, just weather the storm. The
Mm-hmm.
rent drops is more of a temporary situation. Have a solid business plan, get through the next 12, 24 months, and then we'll see where the market and the economy is there. What other tips or feedback would you have for investors making new acquisitions in today's economy?
I think right now managing your debt is more important than ever because that's what's been killing people. Um, we were fortunate that for our last two acquisitions, we bought them with bridge loans, but we were able to secure a fixed rate for 5 years. Um, and we quote unquote overpaid for that interest rate at the time. But because of the rise, we're actually slightly under market now for interest rate, which is great. And by no means was that am I saying that as a way to like humble brag. I didn't know that that was going to happen. I'm just a fan of fixed interest rates. I don't like floating. And in this scenario, I won, right? If the inverse had happened and interest rates had dropped, I would have lost. So I'm not bragging, but I think it's important to take a hard look at the debt and the capital stack, especially if you're a passive investor, right? Because you start getting into preferred equity and mezzanine debt and all this stuff. Really understanding the capital stack and how fluctuations in the business plan can affect those returns and how quickly. For example, if you've got I don't know that this would happen, but if you had an 80% loan to cost bridge debt and then 15% of preferred equity, and then you're going to be a common equity position, that seems really risky, and that might not be the greatest position to be in right now. Versus if you have a property where it's a 50% Fannie or Freddie 10-year loan, and no preferred equity, all common LP equity after that, it's just very different. And I'm not saying one is better than the other. I mean, the first example is extremely extreme, so not really a realistic comparison, but it's all up for debate. But I think really understanding that capital stack and understanding the debt and the triggers and requirements behind it is more important than ever for these next couple years, especially if you're in some of these areas that have been high growth in the past, right? The Southeast, the Southwest. If you're in the Midwest or Northeast, or, I don't know too many years, it might not be as important, but, I think now more than ever, understand that debt is the biggest thing right now.
I think that's really great feedback when you talk about the capital stack. I mean, it's just not talked about enough. But your point is understand who gets paid first and how much of the equity they need to get paid, right? So your lender, that loan, LTV, that's important to understand, which most people recognize that. But if there is a pref equity position, which basically is almost like a second loan, right? It's premium or more senior than you as an LP investor or passive investor. Well, they've got to get paid first. So now you have to weigh, okay, well, how much is that? How much do they need to get paid? What is the pref return? And then what needs to be true before you as an LP investor start to see some profits? And ultimately what you're getting at is make sure that that deck is not stacked so high that you only get the last 5 or 10% of returns, because then the deal has to be great to take care of everybody else before you get it. And just understand that capital stack's important. I would suggest anytime you're looking at a passive investment, if it's not clear to you or you still have some trouble understanding it, just ask the question directly. Hey, can you explain the capital stack? Who gets pref returns? When is it paid out? Just make sure you're clear on that, because those are really important details that you want to understand. Chris,
Yeah.
if folks want to learn more, I know that you do a lot of work for other investors as well. They can go to your website, jagpmg.com, and learn a little bit more about you and your firm there.
Yeah, so that's our property management website. So if you want to check us out there, feel free. Our kind of investment side is jagcapitalpartners.com. But really, if you want to just get in touch for any reason, email is probably the best way. It's chris@jagpmg.com.
Love it. Right now, we're going to transition and go to our round of insights. Chris, give me a failure or an apparent failure that sets you up for later success.
So we bought a triplex 2 years ago that I thought, was a wholesale deal, personal money. It ended up being way more than I thought it would. We basically redid everything. So hopefully we'll make a little bit of money on that now, or break even. But the amount of knowledge I gained by having to literally redo everything was, almost, I don't want to say invaluable, because, obviously I wouldn't lose a ton of money to get it, but it was pretty crazy how much stuff we did and how much I learned. So might hurt the pocket a little bit, but I think over the next 30 years, it's going to be worth it.
Give me a digital or mobile resource you recommend for investors.
I'm trying to think off the top of my head. Honestly, I don't have like one dedicated one. I'm just big on finding podcasts and specific episodes that resonate with me, and then just a wide array of different books. I would say I really liked The One Thing, and probably Essentialism are probably my two favorite right now.
All right. Well, the next question is going to be about the book you recommend. So we'll go ahead and go with The One Thing and Essentialism. So 2 good options right there. Give me a daily habit that helps you stay focused on your goals.
So I found this one really recently, and I'm still trying to use it, and it's been really good. A lot of people use their inbox as a to-do list. And the problem with that is when you get a new email in, it pops up to the top of your to-do list, which is wrong, because not everything in your inbox is the same priority. So I learned from Peter Loman, you find a dedicated like to-do software or pen and paper, whatever, and you take that email, create a to-do list, and you can actually copy it in as a link so that you can click back to it, and then you archive that email out of your inbox. So the goal is to have like, very little or zero in your inbox, and then you work off of that to-do list. So the goal is not to use your inbox as a to-do list and have it completely separate. And I don't do it 100%. I'm still trying to do it, but when I do use that well, it's been really great.
Give me your number one insight for managing properties.
There's a lot. I don't know if there's one. I think the biggest thing is honestly handling maintenance in a timely fashion. Honestly, just doing anything in a timely fashion, right? Getting back to residents, answering leasing inquiries, responding to maintenance requests. But that always seems to be the one that falls by the wayside, right? Once you have somebody in, it's like, all right, now we can kind of pull back. And it's like, no, that's one of the biggest things to, having really high resident satisfaction, having people renew, people being happy, minimizing complaints, which at the end of the day, helps boost that income. So I would say overall, getting back to people in a timely fashion, but, really the maintenance side is one I think people miss out on.
Yep. So you are in Jacksonville. Give us your favorite place to grab a bite to eat.
So we lived in Jacksonville for 3 years. Now we live in Orlando. In Jacksonville, I'm trying to think.
You can say Orlando too. I forgot you told me you moved to Orlando.
In Orlando, there's a place. It's a nicer place. So I don't go there a ton, but it's called Prado over in Winter Park, which has been really good.
Prado it is. Awesome. Awesome. Well, Chris, you gave us a lot of good feedback. I appreciate you talking about kind of your journey and transition, right? Taking 2020, taking a look at your life, being on this, kind of shut in situation in New York, moving to Florida, buying that 16 unit, recognizing the inherent value there, and then realizing that there's an opportunity in this kind of 10 to 80 unit space, launching your own property management company, going vertically integrated with your own assets, starting to work with other investors on their assets, and just talking about the dynamics of the market and how it's changing and recognizing that, hey, we've got to operate a little bit differently when we're not able to implement the value add strategy that has worked so well over the last few years with rents coming down, more concessions, expenses increasing. Doesn't make sense to spend $20,000 or $30,000 renovating to get a $50 premium. So you've adjusted that strategy, but also recognizing that this is a temporary situation. The projections we see on development indicate that there should be much more upside over the next couple of years. So we look forward to watching that kind of transition and just the role you play with those owners, right? Just helping them with the data, with the information, being a great partner, being a great advisor. I think that's very valuable. For folks that want to learn more, they can check out your websites. We'll link to both of those in the show notes, both the Capital Partners site and the property management site. Chris, we just want to say thank you for coming on the show, being a great guest today. We look forward to staying in touch with you, and I hope you have a great day.